Hey everyone, welcome back to Corporate Decoder, the place where we decode the secrets behind corporate filings and uncover the real story behind the numbers. Get ready, because today we're diving deep into Maitong's Sunshine Cultural Development C, Accession's latest quarterly report, and let's just say it's a mixed bag with some interesting ups and downs that tell quite a tale. Before we jump in, if you enjoy getting straightforward, no-nonsense insights from these financial documents, do us a favor and hit that subscribe button. And hey, we've built a fantastic community over on Discord to chat more about these reports. Check out the link in the description to join us. Alright, let's get straight into it. This is a quarterly report, a snapshot of how Maitong Sunshine Cultural Development CSM is doing for the period ending June 30, 2025. Think of it as a quick checkup on the company's health. Right off the bat, we see they are indeed a publicly traded company with a filing history. They confirm they've been keeping up with their reporting duties, which is always a good sign. And they're also on top of their digital filings, which means they're playing by modern rules, top to scroll. Indicate by checkmark whether the registrant is a large accelerated filler, an accelerated filler, a non-accelerated filler, a smaller reporting company, or an emerging growth company. See the definitions of large accelerated filler, non-accelerated filler, a smaller reporting company, or an emerging growth company. See the definitions of large accelerated filler, smaller reporting company, emerging growth company. What this generally means is they're still relatively small and might not have the long track record or massive revenues of bigger players. This also means they might get some leeway with certain reporting rules, but it also hints that they're still growing and finding their feet. Scroll indicate the number of shares outstanding of each of the issuers' classes of common stock as of the latest practicable date. As of the date of filing of this report, there were outstanding 60,500,000 shares of the issuer's common stock, par value 0.001 per share. Dakshral, Extafs and Bakshal they've got about 60.5 million shares of common stock out there. That's a key number that helps us understand how their future profits might be split up on a per share basis. Now let's get to the heart of the matter, the financial statements. This is where we really see what's going on under the hood. First up, the balance sheet. This is like a financial photo showing what the company owns and owes at a specific point in time. We're looking at June 30, 2025 and comparing it to September 30, 2024. Here's our first big financial number, cash. As of June 30, 2025, they had about $250,000 in cash. Now look at September 2024, they had almost $700,000. That's a significant drop, about a 64% decrease in their readily available cash. This could mean they've been spending quite a bit or revenue hasn't been coming in as expected. Keep an eye on that. Their total current assets, which include things like cash and inventory that can be quickly turned into cash, have also dropped substantially from over $743,000 to about $425,000. Again, a big decrease. And look at their short-term debts, their current liabilities. They've come down from about $760,000 to $377,000. This is good news. They've managed to pay off a chunk of what they owe in the short term, which helps improve their immediate financial flexibility. Overall, their total assets have shrunk significantly from around $752,000 down to about $442,000. This aligns with the decrease in cash and other current assets. And here's a crucial piece. Their total stockholders' equity. They've actually moved from a deficit, meaning they owed more than they owned, to a positive equity of about $65,000. This is a positive shift showing they've managed to build some value even with the decrease in overall assets. Now, let's look at how they performed in terms of making money, the income statement. Here's the revenue. For the 3 months ending June 2025, revenue was about $82,000. Compare that to the same period in 2024 when it was over $260,000. That's a huge drop, a decrease of about 68%. They're making a lot less money from sales than they were last year in the same quarter. Looking at the 9 months ending June 2025, revenue was about $1.17 million. This is a big jump from the $525,000 they made in the first 9 months of 2024. So while this past quarter was rough longer term, their total revenue for the year-to-date period is more than double. That's a very important distinction. gross profit, which is revenue minus the cost to produce or buy what they sold, definitely took a hit in the latest quarter. It fell from $170,000 to about $34,000. This is an 80% decrease. This means that for every dollar of sales they made in that quarter, they kept much less than before. However, for the 9-month period, their gross profit actually increased by about 61%, from $273,000 to $440,000. This shows that despite the tough quarter overall for the year so far, they are becoming more profitable on their sales. Now expenses. Selling, general and administrative expenses went up in the latest quarter from about $71,000 to $75,000. Not a huge change in dollar terms, but since revenue dropped so much, it means a larger chunk of their shrinking sales is now going to just running the company. For the 9 months, these expenses also increased by about 33%, from $251,300 to $333,000, to $333% from $251,000 to $333,000. This is the bottom line for operational performance. In the latest quarter, they had an operating loss of about $41,000. Remember, it was a profit of almost $100,000 last year. That's a massive swing from profitable to losing money just from their core business. But looking at the 9-month picture, their income from operations jumped significantly, from about $22,000 to over $106,000. So again, the overall trend for the year points towards improvement in operations, despite a really bad quarter. And finally, net income or loss. The last quarter ended with a loss of about $41,000. Last year, they made a profit of nearly $94,000, a big turnaround. However, for the first 9 months of 2025, they reported a net income of just $9. Yes, you heard that right, $9. Compared to $16,000 in the prior year, this is a bit concerning. While they are technically profitable for the year so far, the number is so tiny it barely registers. It really highlights how that one bad quarter significantly impacted their overall performance. Let's quickly glance at how their shareholder equity changed. Looking at the equity section from June 2024, they had a slight deficit. And by June 2025, their equity is positive, around $65,000. This is mainly driven by issuing more shares and a significant increase in additional paid-in capital, which is like money from shareholders beyond the basic stock value. They issued 500,000 new shares in February of 2025, which brought in a bit more capital. Moving on to cash flows. This tells us where their cash is coming from and where it's going. For the 9 months ending June 2025, the operations used a massive $508,000 in cash. This is way more than the $45,000 they used in the same period last year. This huge outflow means their day-to-day business activities are burning through cash fast. Investing activities typically relate to buying or selling long-term assets. They didn't spend much on investments, actually none in the recent period compared to a small amount last year. This could mean they're not expanding their physical assets right now. Financing activities are about how they raise money, like loans or issuing stock. In the most recent 9-month period, they actually used about $15,000 in financing activities. Last year, they brought in over $226,000 from financing. This suggests they're not raising much new money from lenders or shareholders lately, and might even be paying some back. Putting it all together, their cash balance decreased by over $448,000 in the 9 months. This confirms what we saw in the balance sheet, a big drain on their cash reserves. Just a quick note on how they do their accounting. They're using US Generally Accepted Accounting Principles, or GAAP. They mention fair value measurements, which is standard, but they also state that their financial assets and liabilities generally approximate their fair values because they are short term. This means things like accounts payable or advances from customers are pretty much worth what they say they are, which is reassuring. It's also noted that the company operates in one segment and all revenues come from customers in the People's Republic of China. Most of their assets are also there, so their whole business is concentrated in China. They follow a standard revenue recognition rule, meaning they book revenue when they earn it, which is good practice. They talk about service revenue and product sales separately. This section is really important. They mentioned that in the 9 months ended June 30, 2024, they had 3 major customers who accounted for over 10% of their revenue each. For the 3 months ended June 30, 2024, 2 customers made up 50% and 43% of their revenue. This is a big positive 25. They state they didn't have a single customer accounting for more than 10% of revenue. This is a big positive 25. They state they didn't have a single customer accounting for more than 10% of revenue. This is a big positive 25. They state they didn't have a single customer accounting for more than 10% of revenue. This is a big positive change, showing they've diversified their customer base and reduced that concentration risk. And scroll for the 9 months ended June 30, 2025. The company did not have a single customer that accounted for more than 10% of its total revenue. For the 9 months ended June 30, 2024, the company had 3 major customers that each accounted for over 10% of its total revenue in scroll tie. This shift from relying on a few big customers to a more spread out base is a sign of a healthier, more stable business. Let's talk briefly about taxes. They pay taxes in the US and China. China has a standard 25% corporate income tax. The US rate is 21%. Scroll at difference between the US federal statutory income tax rate. And the company's effective tax rate was as follows. To income tax benefit at USA statutory rate 21%, 21 scrollger at USA statutory rate 21%, 21 scrollger. This is a bit of a puzzle. For the US, their effective tax rate for the 9 months ended June 2025 and 20 effective trade 0%, 0%, 0%, 0%. This is usually because they have a valuation allowance set up against their deferred tax rate. For the 9 months ended June 2025 and 2024 is listed as 0%. This is usually because they have a valuation allowance set up against their deferred tax assets. Essentially, they don't expect to pay US federal income taxes in the near future, likely due to losses vast sent a 0%, 0%. End text. Scroll. The difference between the PRC statutory income tax rate and the PRC effective tax rate was as follows. Up to income tax benefit at PRC statutory rate 25%, 25, 359%, I 19 T 8% 2 and ending 25 was a very high 39. Extant tax rate in 2020-25 was a very high 39. The C 8%, 5% in 2025. PRC 9.38% compared to just 5% in 2025 was a very high 39.38% compared to just 5% in 2025 was a very high 39.38% compared to effective combined tax rate 39.3, effective combined tax rate 39, etc. Effective combined tax rate 39.38% compared to just 5% in 2024. This big jump is due to tax preference and valuation allowance adjustments. The high effective rate for 2025 is a concern and needs more investigation into what drove it. Now, about their internal controls. This section is crucial for understanding how well the company is managed and how reliable their financial reporting is. They admit to some significant issues here. They have a small team, which makes it hard to separate job duties, meaning one person might have too much control over financial processes. Their finance team lacks deep expertise in the US accounting rules as a public company. Reporting requirements, they haven't documented their financial processes or internal controls well enough. This is a big red flag. They've officially stated that their internal controls aren't effective. This means there's a higher risk of errors or fraud in their financial reporting, and it's something investors should pay close attention to. They also mentioned that there have been no major changes to their previously disclosed risk factors. This usually means they're still facing the same potential problems outlined before, which could include things like economic downturns, competition, or regulatory changes, especially given their operations in China and the US. Here's something positive. On February 25, 2025, they issued 500,000 shares of stock for market awareness and investor relations services. This is a common way for smaller companies to get their name out there without spending cash. It raised some capital, and it's good to see them actively trying to build their profile. And finally, we have the signatures of the CEO and CFO, confirming the accuracy of the report. It's signed by Huang Feng as CEO and Shang Jia as CFO. Overall, Maitong Sunshine Cultural Development. CEOs presents a picture of a company in transition. They've seen a huge drop in revenue and a significant use of cash in the latest quarter, which is worrying, however. Looking at the 9-month period, there's growth in revenue and gross profit, and they've improved their equity position and customer diversification. The major concerns are the ineffective internal controls, the very small profit for the year to date, and that sharp decline in cash. The high Chinese effective tax rate is also something to watch. The company is clearly working to grow and improve its stability, but it's still facing considerable challenges. The real question is whether they can sustain the growth seen over 9 months while addressing those critical control weaknesses. What's your take on these numbers and what do they signal for the company's future? Drop your thoughts in the comments below. If you found this breakdown helpful, please give this video a thumbs up. It really helps us out. And definitely subscribe for more financial deep dives like this. Don't forget to join our Discord community linked in the description to keep the conversation going. Thanks for watching and we'll see you in the next one, Kath.